Welcome to UrbanHood, your learning platform. Urban Food Alliance is a 501c nonprofit which reaches out to the needy and the homeless who need warm, fresh cooked, nutritional meals. Urban Food Alliance services the needy in our neighborhoods. Urban Food Alliance works in conjunction with UrbanHood and Speak EQ. UrbanHood is a free learning platform to promote personal development and financial awareness. We simply ask our visitors and members to make a donation to Urban Food Alliance if they are gaining from the knowledge provided. Speak EQ offers classes at low cost and donates the profits from those classes to Urban Food Alliance. Our mission is educating families to build and preserve capital. Our vision is that all families deserve happiness and financial freedom.
Lines of people formed outside of this New Jersey restaurant today. Khan Baba of Franklin Park offers free meals to families every Friday during lunchtime. The response from the community has been overwhelming.
I think it's great because there's a lot of people that are not working and we're all suffering. You know, we have kids, grandkids.
It's very simple. You walk up, they ask for your name, address, and phone number. They asked me how many children I had, and they gave us some little goodies, some snacks for the kids.
Today I'm seeing an enormous amount of people that need help, and it's really it's sad. But we are very happy to help in any way that we can.
The Urban Food Alliance to reduce starvation in local neighborhoods.
And what I see, the Spanish community, they don't get nothing. So I was thinking to help them out because mostly they work in the restaurant business and they lost their job.
In the state of New Jersey, 1 out of 7 people sleep hungry. That's when I said, look, you know, if you look around, your neighbors can go hungry. As you can see that there are 3 organizations come together and to provide the solution here. Urban Food is the one to provide giving the food, and UrbanHood in the middle is the one website, our urbanhood.org. You can look at it. And 3 things UrbanHood offer to our members. We have we offer education where we teach you how to catch the fish instead of giving you the fish. What we have seen, a lot of the organization, they give you something, but they don't give you the secrets how they're making the decision. So our goal is just giving away what we know, what we learn. At the same time, we learn from one another. And the second thing is what we offer, that our application tools, meaning to become a better investor and the informed decision maker. If you are trading or investing for short term or long term, many of you know that the Yahoo is a free data finance you can do. At the same time, Yahoo has the premier membership that is going to cost you money. Same thing that for trading, those who have been trading for recently or learning, that you'll know there is a website called Benzinga.com. Benzinga.com. If somebody can post it on the chat line, please do this. Monthly subscription for Benzinga is more than $100. So what we have, that our members, and then what we put our money in, and then we get a subscription, content distribution, and and subscription for this paid solution, paid the services, and then we create the solution for our members wherein everybody has access to the information, and then they can do their due diligence and research. And the third thing is support for investor. Please mute your line if you're not talking. And the support in investors, the community, we have over 4,000 members in our community. Some of them are short-term, some are long-term, some of them are day traders, some of them are swing traders, some of them are long-term investors, right? Or some of them are just here, still just learning, just figuring out, what to do and taking their journey safely, slowly, right? So with all kind of diversity we have in our community here. So these 3 things, we offer to other members, where you not only learn yourself how to trade, at the same time, if you trade, then how to protect your hard-earned money. That's what we bring to our members. So now I'm going to stop it, but typically every week we meet, with our members that, midday, we go through things like this is an example that every day we do midday 12:30 p.m. to 1:30 p.m. Eastern time. We go through, we talk about live market. We go through the market situation. We offer that what's the economic sector, economic events happening that moves price action in the market, and then we also go over some of the stocks, people have in mind, hey, I'm looking at this stock, what is the good price to get in, or should I keep it or should I sell it? Those kind of things we share. When we share this, all of traders, I myself have more than 25 years of experience in financial world, and last 3-4 years I've been trading pretty much almost like full-time basis. I retired myself about 3 years ago, and since then I just needed to pick up a new hobby. So I picked up this trading, and then while running the multiple charity organization, I just figured I'm going to help others make money, and as others make money, they donate to my cause. That's all my ask to you. So here, these are the things today we have done. We went through like this week, and the earnings coming up, and we every week at Sunday night. If you are looking at our meetups, also you'll see that Sunday night at 9:30 p.m. that every week Sunday night we talk about week ahead, and we also share with you some of the tickers that you can keep an eye on. And then midday we go over each day, and some of these earnings, some of the stickers, what's happening, and so on. So I'm going to stop here.
Who have been trading or actively managing their money, and it's not everyone is successful, but I just wanted to share this with you guys, that there is an approach for hands-off investing. So my thoughts are that not everyone is good at trading, right? Some people are great at trading. They're risk takers. They can make decisions fast. They learn they learn technical analysis. So there are a lot of tools out there for traders, and there are some exceptional traders out there who make a lot of money, but not everyone has that ability to maybe learn how to read charts, or trade, or have the courage to do it, or even have the time or interest to do it, right? So there are many factors where a lot of times people just shy away from it. And again, it's the same thing when it comes to our 401ks as well, because in 401ks we can't, more often than not, we can't invest or trade into individual stocks. We generally do it in mutual funds. So today the topic is, how can we be hands off and invest and do pretty well for ourselves? So first of all, you can see the chart on my screen, and that's for Dow Jones. I think everyone who's on this call, hopefully you guys know what Dow Jones index is. So basically, ETFs can be actively managed, or they can be passively managed, or they're passive ETFs, like they could be mirroring some index. So anyone can come up with an index. So let's say I come up with an index, and I say, you know what, I'm going to track the top the companies in the US with the largest market capitalization. I could just come up with an index of those top 10 companies, and someone can create an ETF tracking my index. So now if someone does that, that would be a passively managed ETF, because I am the one who is managing the index, and someone else is basically just mirroring the ETF based on my addition or subtraction. Now, in my case, the rule is pretty simple. I'm just going to own the top 10 most valuable companies, as in the largest market capitalization of these companies. So, so for me, there is no work either. Now, if there are, if it's, there can be actively managed ETFs, and there are, and I'll share with you. The benefit is that, you know, you have someone experienced who is managing that money, but a lot of times can everyone hear me?
Yes.
Okay. So a lot of times, you know, not everyone can really outperform and do pretty well, right? So here I have Dow Jones Industrial Average, and where the starting point on the bottom left-hand side is March of 2009, and that's where, after the financial crisis, that's where the market bottomed, and where we are today, roughly 10 years later, Dow Jones is up 309%. Then the next most famous, one of the most famous indices is S&P 500. So the ticker symbol for SPY is an ETF for S&P 500, and since 2009, March of 2009, it is up 380%. So $10,000 invested in 2009 would be right now $38,000, or $100,000 invested back then would be $380,000. So pretty substantial. Now, another famous index, which a lot of people are monitoring, is NASDAQ 100 index. So this, what NASDAQ 100 index does is it takes the top 100 companies of NASDAQ, as I was explaining with the with my own index, right? So it takes the top 100 companies of NASDAQ, and it made a lot of big tech companies and biotech companies. Lucky for NASDAQ, they're listed on the exchange, right? So in this case, this is a bunch of companies listed on NASDAQ, which is a stock exchange, and they made an ETF out of, or index out of it, that will track the top 100 companies that are listed on NASDAQ. I think there is an index for New York Stock Exchange, but it's not very famous. So NASDAQ is roughly 940% up from the March lows, same time period. So 320% or something for 310% for Dow Jones, 350% or 380% for S&P 500, and 940% for NASDAQ 100. So 10,000 invested is worth 94,000, or 100,000 invested is worth 940,000. So that's pretty substantial, and with no effort whatsoever. So back in 2002, I took an investment analysis class. I went to Baruch College, and one of my professors, my investment analysis professor, he used to manage a hedge fund, a $300 million hedge fund back in 2001 or something. And he used to teach investment analysis at Baruch College, and he used to teach technical analysis at NYU. So, you know, pretty capable guy. And he said that if there are two people and two investors, and one investor just simply keeps putting money into an ETF, or into an index, at that time he said index, and on the other hand, there is an investor who actively looks at the market, reads and follows the news, actively trades, you know, keep tight leash on his or her portfolio. 10 years later, if you compare the two, the guy who simply invests in an index and goes for 10 years and lies on a beach somewhere and enjoys his life, when he comes back and you compare their portfolios, more likely than not, the person who simply invested in an index would outperform the person who would actively manage their portfolio. So I took it upon that as a challenge. I wish I didn't. And I tried to actively manage my portfolio. And guess what? 20 years later, I'm preaching other people that, that this is a really good way to go.
Hey,
So,
Ali, can I pause you? Just wanted to make sure you know somebody asked a question. What is the difference between index and ETF? Can you
sure.
give a little bit definition to people who's new?
Yes.
All right, thank you.
Okay. So index is anyone can come up with an index and say, I'm going to take, I'll continue with my example of coming up with an index of top 10 companies of in the US. So I'll probably get Apple, Microsoft, Amazon, Google, maybe Facebook, Visa, MasterCard, so on and so forth. So now once I come up with these um, top 10 companies, I have created an index. So with indexation, it's a statistics concept. With indexation, when you take these 10 companies, you start your index with 100. So now collectively, when they perform well, the index, let's say collectively, all these 10 companies, some go up, some goes down, but collectively in one day they went up 2%. So my index would go up 2% and it would go from 100 to 102. ETF is an exchange traded fund. Just like a mutual fund is where people get together, so it's mutual, people are getting together, and they put money into a fund and they get someone to manage the money for them. ETF, on the other hand, exchange traded fund, is traded on the exchange, on any stock exchange, and people can easily buy and sell it. Mutual funds, however, you have to, they only trade, you can only buy or sell at the end of the day. If you own less than 30 days, a lot of times they hit you with fees of 2%, so on and so forth. So ETFs allow a lot more flexibility, but the money that you've invested into an ETF, they can either actively manage it, they can take it and invest into different companies, or they can say, we'll follow an index. So now my index, Ali's index of top 10 companies, what they'll do is they'll try to mirror it. So if I have, and because my ETF, let's say, is based on market capitalization of these top 10 companies, Apple being at 1.6 trillion, Microsoft 1.6 trillion, Amazon 1.5 trillion, Google at 1 trillion, so on and so forth. So based on that weightage of market capitalization, I would come up with the weighting to mirror that in my index. And then an ETF would try to mirror me based on my index. So that's the difference between indexation, index. There's actually no money in there, right? There is no one buying or selling an index. You can buy or sell an index using an exchange traded fund or an ETF. So what you're seeing on the screen, which is QQQ, it's basically an exchange traded fund following an index, which is the top 100 companies of NASDAQ. SPY is S&P 500, which is an ETF following the S&P 500 index, which has roughly around 500 companies in the US. And they have their own criteria of how they add or remove companies from S&P 500. Like these days, there's a lot of talk of Tesla being added to S&P 500. So right now, Tesla is not part of S&P 500, but if they meet all the criteria, there has to be, certain number of quarters or where a company has to be profitable, and there's some other criteria based on which S&P Standard and Poor say, okay, we can add this company into our index, but then one has to go. So then, and then they would remove one company from the index. So over time, a lot of companies um, have been added or removed from S&P 500 or various, like Dow Jones index. For instance, General Electric was at one time part of Dow Jones. I don't think it's part of Dow Jones anymore. And you can see the components that make up these companies. So I'm just going to go, or sorry, index or ETF. So I'm going to go into DIA, which is an ETF that follows Dow Jones Index. And when you type in on Yahoo, you can simply click on components or holdings. Yeah. I think this is, because it's an ETF, it's only going to give me the top 10 companies of, top 10 companies of Dow Jones. But if I were to go back to Yahoo Finance and click on Dow Jones right here, it's going to tell me, it doesn't tell me. Okay. At one time, it used to have components, and it would list the entire list of 30 companies. But if you Google it, you should be able to find it. But let's go back to the main reason for this talk, which is you can be very your investments can do pretty well being hands-off invested into these ETFs. So even if you think about owning real estate, right? You would do pretty well owning real estate over a long period of time. And if you think about all the people who have benefited, or if you look at the top richest people in the world, you would find Bill Gates, Jeff Bezos, Warren Buffett, so on and so forth. Like all these people, they started their companies, they invested in their companies, and they held those companies for a long period of time. They weren't actively trading, right? They weren't saying, okay, the market is going to take a dip right here. Jeff Bezos is not going to say, okay, you know what? Let me take down my holdings of Amazon from, let's say, 30% down to 3%. Or, because the market has gone up so much, I should start trimming my Amazon position. He's not going to do that. Neither is Warren Buffett. Neither is Bill Gates, right? They'll take a small piece. They might, buy a house or a mansion or whatever they buy. Warren Buffett is going to buy a house, if so, and others are going to buy mansions. But that's the thing. So now, if you are interested in, let's say, investing into ETFs, you can use, I'm just going to share one site today, which is ETFDB. And how can you find ETFs for yourself? So if you go into tools and you go into ETF screener, ETF screener. So you'll see that this gives us this just lists all the ETFs, which are 2,324 ETFs. So out of 2,324 ETFs, I want to just go over just these filters on the left-hand side to find what you're looking for. So let's say we are looking to just simply invest in the market and see how we're going to do. But just before I go into it, how to look for ETFs, since we just spoke about S&P 500, I just want to show you that S&P 500 has various sectors, right? What is a sector? So overall, the stock market has, let's say, roughly over 6,000 stocks trading on different exchanges. So collectively, all those stocks trading on different exchanges become the stock market. Now, stock market is different from an economy. There are a lot of businesses out there that are not traded on an exchange. So all the businesses, whether they're traded on an exchange or they're not traded on an exchange, they're part of an economy. So all the businesses that are traded on an exchange, collectively it becomes the stock market. And then a handful of companies, when they're picked and carved out in different shapes or form, they become they're either put into index funds or indices, or they're put into different sectors and industries. So on the screen, you can see that there are various sectors within S&P 500. We spoke that S&P 500 is an index, but then it breaks out all the companies within S&P 500 and puts them into different sectors. So XLK is one of the ETFs that tracks technology. So technology is a sector. Discretionaries, consumer discretionaries is a sector, which means consumers have a discretion to buy or not buy those goods or services. Like Amazon is a consumer discretionary. And then we have healthcare. SPY is just SPY. Then the next sector is industrials like Lockheed Martin or Honeywell or 3M, right? Those are industrials. Consumer staples are goods that people are, it's tough for them to live without. So for instance, cigarette manufacturers, beverage, I think alcohol, that would be in consumer staples. Utilities is electricity, water, gas, that's utilities. Real estate is real estate. But any company can make themselves into a real estate company, like a REIT, which gives them a special status from a tax perspective. And they have to distribute 90% of their earnings back to the shareholders in forms of dividends. So, for instance, there are some tower companies like cell phone towers. There are cloud, excuse me, there are cloud companies that have a real estate, a REIT status that are part of real estate. So that's real estate. Then it's materials like Dow Chemical, that would be considered a material. Financials is all the banks and those kind of companies. Consumer services is a new sector that they've carved out of technology, which has all the media companies. So Google, Facebook, Twitter, they're all part of communication services. And energy is oil sector. So that's the breakdown of different sectors. And if you look at the returns in the past 10 years, technology is up 500%, discretionaries 400%, healthcare a little over 300%. Overall, S&P 500 is 265%, industrials 208%. So just by being hands-off, you could do pretty well over a long period of time. Now, how do you filter and find ETFs? So either you could go with the, I'll just go over some of these columns over here. Symbol is, these are the symbols of these ETFs, that's the name, what kind of asset class it is, and I'll just go over the asset classes over here, which is whether they're alternative investments, bonds, commodities, currencies, equities, multi-asset preferred stock, real estate, or volatilities like VIX. So let's say we are looking to invest in stocks, ETFs, so we can simply select equity. So now that reduces ETFs to 1,580 ETFs. And then total assets is how much money is invested in these ETFs. So in SPY, it is $290 billion that is invested into SPY. So now if you look at the name over here, so a lot of ETFs can be tracking the same index. So this is a spider ETF, but it's tracking S&P 500. This is iShares, which is another company, which is BlackRock, and it is tracking S&P 500. Vanguard is a separate money manager tracking S&P 500. So all three ETFs are tracking the same index. So now, which one would you pick? If you look at it, right, the size of these funds is all of them are pretty big funds, right? And if you look at the percentage performance year-to-date price change, which is performance, is 1.8%, 1.8%, and 1.75%. Pretty close to one another, right? So, but the price could vary, right? So, with iShares, you're going to get a little less number of shares versus if you go with the Vanguard S&P 500, if you want to invest the same amount of money, you're going to get a little bit more shares. So price point is different, but one thing that you should take away from this, never worry about the price. Price, it is what it is. If they divide 324 by 10 and they do a stock split of this ETF, it's going to go down to $34 a share, right? But there will be more shares out in the market. But the performance is still going to be 1.8%. So don't worry about the stock price. When you are investing, you should think about from an overall portfolio perspective and say, okay, how much money do I want? How much percentage of my portfolio do I want in S&P 500? So this way you can simply say, okay, you know what, I want 50% of my portfolio into S&P 500, and you'll take the total dollar amount, you'll pick one of these ETFs, and you'll put your money in there. One thing that does make a difference is how much are you paying them to manage it, which is expensive. So staying with S&P 500, and I haven't changed any sorting over here. So if I just click on expenses, it's going to tell me SPY, you're going to pay 0.09%. So that is very small amount, right? It's 0.09%, like divided by 100. So that's what you're going to pay if you put your money into SPY. If you put it into IVV, you're going to pay 0.04%. If you put it into VOO, you're going to pay 0.03%. So if you are going to invest in S&P 500, this might be the best option for you because this is going to be the cheapest way to invest into S&P 500. And then you can also go into returns to see how have the returns been. And you can see that the returns have been pretty close to one another. But if you see over the past 5 years, SPY is slightly lower than IVV, which is slightly lower than VOO. And maybe it could have to do something with the amount of fees that they're charging. So, but anyway, I think you should focus on returns first. That's what I do. A lot of people get hung over with the amount of fees that they're paying. But what I do is I focus on returns first, what my vision is, and then focus on fees, right? Because just think of it like whether you're taking your wife out for dinner or your date out for dinner, and if it's a special occasion, the last thing you're going to worry about is if the restaurant is expensive or not, right? You're first going to worry about the impression that you're going to make. So to me, the impression that's made on me, it's by returns first and then expenses. So now moving on, once I select equities, I can filter through, whether I want to look into small cap ETFs or mid cap, mega cap, large cap, what have you. Whether I'm interested in growth or value. Is there a specific region I want to invest in? Is there a specific sector I want to invest in? And then there are some investment styles over here. You don't really need to mess around with it too much for now. If you have any questions, we can go into it afterwards. And then if I go down further, attributes, this is what I do filter for. So let's say I don't want I don't want anything which has leveraged, right? So I can click on no. I don't want inverse ETFs. So leveraged ETFs is, let's say S&P 500. If there is an ETF that is 2 times leveraged, that means if S&P 500 goes up 1%, that leveraged ETF is going to go up 2% or vice versa. If it goes down 1%, S&P 500, then the leveraged ETF is going to go down 2%. Inverse means if S&P 500 goes up 1%, an inverse ETF is going to go down 1%. And then tax forms, this is, if, well, in this case, it's all 1099. So you don't have to worry about that too much. So for me, the biggest things over here is whether I want a leveraged ETF or not, and whether I want an inverse ETF or not. So now just with those 2 more selections, I have eliminated another roughly 100 plus ETFs. Continuing down, I don't really care about who's the issuer. You might consider it. Let's say you have an account with Fidelity or Vanguard, then you are going to maybe care about it. Maybe they're not going to charge you any fees to get in or get out, or provide you with some other perks. And let's say that might be one of the reasons why you might be looking to filter on an issuer. Structure, you don't have to worry about this too much either. Whether it's an exchange traded fund or exchange traded note, but they all trade pretty similar to one another. Expenses, we spoke about expense ratio. So let's say, just to give you like a benchmark, if you're looking for low expense ratio on a broad index, then generally you're going to find what I would categorize as a low or a cheap fee or expense ratio would be probably less than 0.2%. That's 0.20%, right? If something's in between, that would be between 0.2 and 0.5%. And anything above 0.5% would be, I would categorize that as expensive. But many times, if you're looking at managed ETFs where there is an investment manager that is actively managing that ETF and it's not based on an index, then you'll see that the expense ratio is going to be above 0.5. And then dividend yield is, if of course, if you are looking for an ETF that pays out dividend, then you'd look for that kind of an ETF. Liquidity, that's going to tell you the size of the fund, volume, what the price of an ETF is, how long has it been out there for, then what kind of returns has it had over various time periods. ESG score, I don't know what ESG score is. Funds flow is over the past 1 week, 4 week, year to date, 1 year, has funds come into this ETF, into certain ETFs or out of certain ETFs. This might be a good gauge if you're trying to figure out, where is the money flowing towards. And then risk metrics, this will become a little complicated. Standard deviation, PE, I would stay away from it. Holdings, again, this has some uses, but not too many. Let's say you're looking for more of a concentrated ETF, and I can touch upon this too. And what else is there? Popular theme, yeah, this is like some of the popular themes and what ETFs are covering. So now, without filtering too much, I have 1,410 ETFs, right? So now I'm looking for an ETF to invest in, and I want my first thing is that I want to see which ETFs have performed the best over the past 5 years. So once I sort it, sorry. So now once I sort it, this gives me the best ETFs in the past 5 years. So now when you look at it, because I want to understand what the theme is, what has the market done in the past 5 years, and what sectors or funds are doing the best, right? So if we go down this list, and you'll see some of these ETFs, ARKW, ARKK, and then over here we have ARKQ, and most likely on the first page there might be ARKG, right? So these 4 ETFs are managed ETFs. So there's a firm called ARK Invest, ARK-Invest, and they have thematic ETFs. They have ETFs based on a certain theme. So the theme over here is internet. Innovation is a combination of internet, industrials, and genome, which is right here, industrials and genome. So ARKK is a combination of these 3 ETFs, and then Q is industrials and G is genome, which is biotech. So now, just by looking at this list, I can see that internet sector has done pretty well. I know what the combination in this is. Then the next best performing is semiconductors. So there are 2 semiconductor ETFs. Then a gold ETF, but this is gold explorers. This is not a gold, the commodity. Then semiconductors again. So this is a 3rd semiconductor. Here's a 4th semiconductor. Here's software. So here's a gold miners again. This is technology, NASDAQ 100 technology. And this is technology again, Vanguard technology. And then a lot of times you'll see that some of the ETFs are following the same index. So if you look at Vanguard technology, XLK, and I think there was one other FTech, all 3 have pretty similar holdings. So what I normally do next is there is, and I can share this link, there is a link of Morningstar, which I really like. It shows me the top 25 holdings of an ETF. So the things that I like to focus on this page is how much concentration is in the top 10 companies. So without having to do active management, 56% of QQQ is in the top 10 companies. So over here, there are 2 Google names over here. These are the 2 asset share classes. So that means in 9 names, your money is immediately diversified into 9 companies, adding up to 50 some odd %. And then you're getting exposure to various other companies. So if you look at these names, Apple, Microsoft, Amazon, Facebook, Google, Tesla, Intel, Nvidia, Netflix, Adobe, PayPal, right? So now just by looking at these names, if you were to go out and construct a portfolio for yourself, there's a chance that you might end up with these same names in your portfolio. So you can simply pick some ETFs and just invest that way. One other thing that I want to show you over here is ETFDB /stock, and then let's say you want to invest in Amazon, but Amazon being over $3,000 and you don't want to pay $3,000 for one share, what is another way you can maybe pick an ETF and get an exposure into Amazon? So here we have FDIS, which is a Fidelity Consumer Discretionaries ETF, and we just saw over here that in the past 10 years, consumer discretionaries was one of the best performing sectors, up 407%. So now Amazon being part of consumer discretionaries, you can see that FDIS has the largest holding into Amazon, and you're paying less than 0.1%. So that's pretty inexpensive. And you can pick an ETF from over here. Now, if I were to say, okay, you know what, I'm really interested in investing in Amazon, and FDIS is giving me a large exposure to Amazon, but what else does it have? You have to look under the hood. You can look at a bright red Mustang and you say, oh wow, this car looks great, but what if there's no engine in there, right? So you want to look under the hood and see what other components does it have. So what I do is I come over here, I replace QQQ with FDIS, and it's going to give me the top 25 holdings of FDIS. And right away you can see 65% of this ETF is in top 10 companies. And but overall it has 257 companies. And if I scroll down, you can see that the holdings are Amazon, Home Depot, Tesla, McDonald's, Nike, Lowe's, Starbucks, Booking, which is Priceline, TJX, Target, Dollar General, so on and so forth, right? So when you look through these names and you look at the top 10, you'd be like, wow, these are all great companies. So just by investing into one tip, you're getting 65 months into these stocks. Use this. So this helps me identify various areas that I'm interested in. So just by looking at this list and thinking to myself that, okay, given that we're going through COVID and a lot of companies are coming out and talking about how important technology is and how they need to fast track it, and no matter whether they're making money or losing money, they have to invest in technology, right? Because people who were shying away from this, they really have to do it now. So that's the theme over here. So I would want to invest in software. I want to invest in semiconductors. And then, I would go down the list, and then you can see over here industrials. I would want to invest into industrials, and so on and so forth. So now, and then of course biotechnology, right? Because of this whole healthcare issue. So let's say I'm looking for a biotech ETF. Technology, a lot of people are very familiar with, right? Biotech, a lot of us, we're not familiar with. We're not doctors, and a lot of people right now on the call might be from IT background, but not from healthcare background. So how do we pick an ETF from a healthcare perspective? So I would go into sector, I would scroll down and go to healthcare, and I could click on broad healthcare, or I could just click on biotech. And that's 14 ETFs versus 48 ETFs in healthcare. So once I click biotech, now it tells me, because I still have it sorted on returns, so I have these top 14 ETFs available to me. And this is, this just maybe signifies my point that look at 5-year returns of ARKG versus look at the second best performing ETF, which is FBT, and that's 37%. So no matter what the fees are for the rest of these ETFs, they might be, it's very well worth it to pay higher fees to invest in this ETF. So now if I go up and sort by expenses, just to see how expensive these ETFs are, and you'll see that the best performing ETF is 75 basis points or 0.75%. And you can find cheaper ETFs paying 0.35, So there are ETFs out there. You can pay less, 0.35, right, to invest in biotechnology, but you're not going to get the kind of returns that you're getting in ARKG. Now, this is a managed ETF, so there is someone actively buying and selling and making decisions and carrying out research. So their past performance is no guarantee of future returns. So if I were to invest in biotechnology, I might pick different ETFs. And just because I know I'm just going to share like what I pick, maybe I'd pick, let's say I want to divide 10% of my portfolio into biotechnology. So I might say, okay, out of that 10%, I'll pick 3 different ETFs and divide equal amount of money. So ARKG being actively managed, XBI and BBH are based off of an index. So XBI, and when I go over here and I type in XBI, one thing that I want to point out is refreshes. Sorry, I'm away from my router, so can you guys hear me?
Yeah, Ali, we can hear you.
Okay. Okay. Anyway, while it refreshes. So coming back over here, so XBI, I'll just explain to you. XBI is an equal weight index. What that means is on a quarterly basis or semi-annual basis, they might look at the overall portfolio and they might divide, they might sell better performers and allocate that money to underperformers, and then they might maintain the same ratio across investments. BBH is based on, I think, market capitalization, and it does not do that. So in such stocks where they're equal weight, you'll see that the turnover is going to be pretty high, where there'll be too much buying and selling, but then concentration into the top 10 names is going to be pretty small. So if I scroll down, you'll see that they are pretty equally divided amongst these companies, and there are 133 companies in this ETF. But if I now change it to BB8, you'll see that a pretty large amount
Ali, I think we lost you here. Ali, are you here? Mushi, there seems to be some problem with the net connection, or
Okay. While he's coming back, let's go through some questions. Can we go start from the beginning, guys? And
Sorry about that.
Okay, Ali, you're back.
Yeah.
We had, let's see. Okay, you still have the connection is there. Okay, go ahead.
Okay. So I think I've covered what I wanted to cover. Just give you guys an overview that hands-off approach can be pretty fruitful. You can pick based on what you think in the next 5-10 years, how the economy is going to shape up. And my guess is the next 10 years are also going to be pretty similar to the past 10 years, where technology is going to lead, consumer discretionaries, followed by healthcare, and followed by industrials. And I think one other sector, which is communication, that is going to also be part of the top 5 best performing sectors in the next 10 years. So me personally, I'm probably, I love investing in ETFs, and I'd pick ETFs from these 5 sectors, and I'd probably invest in that. So with that, I'll just pause here and let you guys ask questions if you have any.
So Ali, there are some questions on the chat line. If you want, I can go through them.
Yeah, sure.
So there are a few questions, but one of the question I know as an interesting answer because you covered it in the fundamental class, and I'll just go with that. Someone asked that, if we know S&P 500 will grow in next 5 to 10 years, then why not we go with the leveraged ETF? What are the drawbacks of leverage?
Yeah. So the drawbacks of a leveraged ETF, and maybe I can show you on a chart. Here is an oil ETF, and I'm just going to compare it to a leveraged oil ETF, which is, I think, triple leveraged, and that's the drawback. So let's say starting from the same point, and even if I go to year to date, you can see that this year USO went down 71% and UCO went down 93%. So oil has to rally quite substantially for a triple leveraged ETF to come back and catch up to it. So if I go back to 5-year performance comparison, that's negative 97%. Now let's compare another leveraged ETF, let's say IWM, and again, you're right. If the performance is well, then you're going to be fine. If you're going to buy and sell, then you could be in trouble. So S&P 500. So that's S&P 500 over the past, let me do 5 years, and I'm going to compare it to UPRO, which is, I think, triple leveraged, and that's UPRO. So you can see that for many years, like, from 2015, sometime in 2015, someone invested in UPRO would have been up 240% versus 58%, but just this recent downfall brought it even down further than S&P 500's performance, and you're down to 13% positive. And if I just do year to date, you can see that S&P 500 has regained, it's broke even for the year, but there's still a long way for a leveraged ETF to come back and catch up with S&P 500. So it's still underperforming by 30%. So are there any uses for leveraged ETFs? And the answer is yes. A lot of traders, and if you're a good trader, you can buy these leveraged ETFs and make some good money. But if you get stuck at the wrong turn like this and you hold on to it without knowing and without having a strategy, how much lower can it go, you could be losing substantial amount of money. I hope I answered the question.
Yes. Yeah, I'll move on to the next question.
Yeah.
Someone asked that he uses Robinhood, so it's like no expenses and because of the platform. So are there any expenses involved when he's buying an ETF?
I don't think, I'm not familiar with Robinhood, but I don't think there'll be any trading cost of buying or selling ETFs. Maybe I think the only cost would be the expense ratio of an ETF, where the ETF is charging money. But other than that, probably Robinhood should not be charging anything.
That's right. And the next question is, I think you covered it. Someone asked how to check which holdings that particular ETF is invested in.
Right.
Maybe
Use that link.
Yeah. And someone wants the Morningstar link that you use.
Yeah, I
maybe,
can send that.
yeah, you can send
I'll
it out.
send it in the chat.
Yeah. Someone has asked me privately if you can show how to find an ETF on different subsections, like very smaller sections, say for example work from home companies ETF. I mean, is there a way to find that out?
Sure. I'm just gonna. Okay. So I just sent over the link in the chat. But work from home, because there is a new ETF which is focused on work from home called Work from Home. But again, someone just came up with this ETF, and Morningstar hasn't updated the holdings in this ETF. But if you could think about it, right? And you could say, okay, from a work from home perspective, what is the new trend? The new trend is technology, online shopping, right? So let's say you want to find ETFs for those two things, right? And within technology, let's say you're bullish on software and semiconductors. So here I have, starting from scratch, I would go into equities. I would go into, well, I would want to maybe pick US. Then I would go into technology, but I would not pick all of technology. Maybe I'll pick, well, there should be cloud computing, but there is an internet architecture, and there is a semiconductors, right? There's software. So I picked those, right? So now I have picked from a technology group. I've picked these, and again, doing my drill, I'd want to see the best performing. Oh, one thing that I didn't do is exclude, but I mean, it's up to you if you want to invest in leverage. Just know the risk. But I'm just going to exclude leverage for now, so that we can just focus on non-levered basis and no inverse. So here I have, again, the best sorted by performance, ARKW, semiconductor, SOX, and then SMH. And again, you can look through the holdings. You can look at the expense ratio and pick maybe one ETF for semiconductors, one for internet. Here we have cloud computing ETF. Here's an internet ETF, right? Here's cybersecurity. Here's cloud computing again. So you can go through these, and we have what, 19 ETFs, right? So we have shortlisted to 19 ETFs. and this would help you to filter through and find. Does that help?
Yeah, of course. And anyways, we are going to open up the line. So if there are any more questions, people can ask directly. Right now, I'll just read out one more question from the chat line, and I'm reading it from the question. Says that, can you share some light on Gush and Drip 2x ETF? Do they go exact inverse of each other? And in case of crash, can this ETF cease to exist?
Okay.
Exist it must be. And what is my risk worst crash?
Okay, so let's see. Gosh, I don't know about these years, but let's see. Oh, wow. Gosh, did I pick out the correct one?
Yeah, it is.
Yes, this is
Okay.
my question. So yeah, it's an oil ETF, and I've been watching them. I've been actually trading them for a couple of weeks, and it's been managed by the same company, and they're supposed to be exact inverse. For example, today, Gush went up and Drip went exactly down. So I've been trying to hedge, based on oil movements.
Yeah, so we can simply do that, right? Gush and Drip.
Yeah.
Yes. Here we have Gush and Drip. And what I can do here is probably move. So now you can see in the past 3 months, or I can do 1 month. You can see, and maybe I will do a different color. So now you can see that, they're sort of going opposite of one another. And we can do a 1-day trend and see. Yeah, so one went up 13.51%, the other one down 13.75%. So minor difference, but yeah, more or less they go opposite of one another.
And is my risk in ETF same as like investing in any stock, like this type of ETF, like on Chevron, because this has Chevron, for instance, right? If I'm assuming if Chevron cross, like, it's not going to happen,
Yeah.
but crash, it will take appropriate proportion. So I guess it's not really beside 2x. It's same as investing in stocks, right? The ETFs
Yes.
in general.
Absolutely. A blended return of the holdings is going to generate, the returns of your ETF. So a lot of ETFs also have like NAV, which is published. So sometimes ETFs trade above and below their net asset value. So collectively, all the holdings of that ETF, if you take the net asset value of those holdings, is going to be pretty close to the ETF value at the end of the day. So so most likely the change in one stock is going to impact the change in the other. Indeed.
Hi, Ali. I had a question.
Yep.
So recently, sometime in May, there was news about some ETFs being discontinued, and I think they were pretty heavily traded ETFs as well, and people who were holding them were given a month's time to sunset it. So if you are a passive investor and if you have long-term plans, and if you invest in an ETF, that puts you in a very difficult situation. So what are the reasons for these kind of decisions, and what should we be looking out for?
Okay. Can you give me one example of an ETF which was discontinued?
I don't have it handy, but
so Ali, they are from Credit Suisse, TVIX, and yeah, those like
you
bunch of them,
yeah. So maybe Credit Suisse is just getting out of that business.
Credit Suisse has done that in the past also. So they need to be watched. You can't be a long-term holder of those ETFs.
Yeah.
Credit Suisse has done multiple times in the last 3 years. They just take them out and you lose everything.
Hey, this is Jay. Let me add to that Credit Suisse, DGAS and UGAS. It's not because Credit Suisse is getting out of the business. They receive a lot of complaints about that ETF because a lot of people lost money on the, not the inverse, but the proper one between February and May due to the COVID. So that, and they had a lawsuit. So they didn't want to go through this lawsuit. So that's why they did.
Yeah, thanks for adding that color. I mean, these things happen, right? So something similar happened to one of the oil ETFs when, you know, oil crashed and went below zero in value, but that was, but the oil ETF didn't move that much because they had already rolled over to the following futures, right? So yeah, sometimes because these things are not designed for perfection, and there could be issues that could come up, and there can be issues with that.
Thanks for watching. Visit our website, urbanhood.org, and join our community at meetup.com and look for financial freedom for you. Thank you, and we hope to see you soon.